Assalamualaikum and hi to our respected lecturers Mustafa Kamal bin Mat, and hello everyone. Today we are from Group 2 and we will be presenting our analysis of corporate financial performance. The title of our project is A Trend and Comparative Study for the company that we choose, Precious Metal Aluminium Holding Berhad and Malaysia Smelting Corporation Berhad. This presentation will cover various aspects of financial performance including liquidity, profitability, leverage and activity ratio for both companies over a 4 years period from 2021 to 2024. Before we start, allow me to introduce the members of our group. The first one, Muhammad Faris Iman bin Muhammad Fazil, Sarah Aina binti Muhammad Saleh, Muhammad Ashraf bin Mohtar, and myself, Nur Izzati Nadia binti Muhammad Awi. Without further delay, let's begin our presentation.
Hello everyone, my name is Sarah Aina binti Muhammad Saleh and we will be presenting on analysis of corporate financial performance. There are two companies that we will be covering on, and that is Precious Metal Aluminium Berhad and also Malaysia Smelting Corporation. Let me start with Precious Metal Aluminium Holdings Berhad, or we call them as PMAH, the largest fully integrated aluminium producer in Southeast Asia. Precious Metal was founded over 30 years ago and has grown significantly to become a leading supplier of aluminium products such as billets, rods, and extrusions. These products are used in various industries including construction, packaging, electronics, and transportation, both in Malaysia and even internationally. The company's headquarters is located in Selangor, Malaysia. It operates several production facilities in states like Sarawak, Johor, and even Negeri Sembilan. To strengthen its international presence, Precious Metal also has offers in countries such as Australia, UK, and also United States. It is also listed on the main market of Bursa Malaysia and is part of notable indices like the FTSE For Good Bursa Malaysia Index and the MSCI Malaysia Index, showing that its strong performance and has a good governance. In recent years, Precious Metal has placed strong focus on sustainability. One of its major efforts is investing in low-carbon aluminium production. Their signature product, we call as GEM, is produced using hydropower electricity, which is significantly reduced carbon emissions compared to the conventional methods. This is a major step towards environmental responsible manufacturing. To support its operations and reduce dependency on third parties, Precious Metal has also invested in upstream activities such as bauxite mining and alumina refining. This helps the company secure a steady supply of raw materials and maintain better control over its production chain. Precious Metal Aluminium Holdings grow both locally and globally. By combining innovation, sustainability, and strategic investment, the company is not only a market leader but also a responsible corporate player. Alright, let's move to Malaysia Smelting Corporation Berhad, also known as MSC, a long-established leader in the global tin industry. MSC has a rich history dating back 1887 when it became as the smelting division of the Straits Trading Company. Over time, it has grown into one of the world's largest tin producer, known for its strong expertise in tin smelting and refining. MSC operates across the entire tin value chain, including both upstream mining and downstream smelting refining activities. Its main smelting facility is located in Pulau Indah, Selangor, and uses advanced top submerged lance technology, or we call it as TSL. This technology improves processing efficiency while lowering the environmental impact. MSC also known as but they own Rahman Hydraulic Tin Sedan Berhad, which is the largest operating open pit tin mine in Malaysia. In 2022, the company strengthened its mining activities by acquiring Asas Baiduri Sedan Berhad, adding over 500 acres of mining land for future expansions. MSC is also known as for its high purity refined tin, sold under the brand name Straits Refined Tin, which is registered on the London Metal Exchange, and this shows global recognition and trust in MSC's product quality. The company is also committed to sustainability. MSC has adopted a solar energy in its operation and actively supports research and innovation through its involvement with the International Tin Association. Malaysia Smelting Corporation, MSC, continues to lead the tin industry through a strong balance of tradition, technological advance, and even environmental responsibility. Its strategic growth and long-standing expertise make MSC a key player in the global metal markets. In this part of presentation, I'll be discussing the liquidity ratio analysis, specifically focusing on the current ratio and quick ratio for both Press Metal Aluminium Holdings Bhd and Malaysia Smelting Corporation Bhd from 2021 to 2024. Let's begin with the current ratio, which measures a company's ability to pay off its short-term liabilities using its current assets. From the graph, we can see that press metals current ratio steadily increased from 1.10 in 2021 to a peak of 2.04 in 2023 before slightly declining to 1.94 in 2024. This upward trend suggests that press metal has managed its working capital efficiently, possibly by increasing cash receivables or reducing current liabilities. On the other hand, Malaysia Smelting Corporation started at a higher ratio of 1.54 in 2021 and peaked at 2.08 in 2022, but experienced a consistent decline, ending at 1.80 in 2024. While both companies are above the benchmark of 1.0, MSC's downward trend could indicate increasing liabilities or reduced liquidity asset growth, which may affect short-term liquidity. Let's take a look on the quick ratio. Press Metal's quick ratio showed a strong rise from 0.51 in 2021 to 1.60 in 2023, then slightly dropped to 1.49 in 2024. This consistent growth reflects strong liquidity and improved financial management, indicating that Press Metal can cover its short-term obligations even without relying on inventory. In contrast, Malaysia's Smelting's quick ratio remained below 1.0 throughout the period. It peaked only at 0.69 in 2023 and dropped again at 0.54 in 2024. This suggests reliance on inventory or less efficient conversion of assets into cash, which may pose short-term liquidity risks. To summarize, both companies have maintained healthy current ratios above 1.0, but Press Metals shows a stronger and more stable liquidity position, especially with its quick ratio also being consistent above than 1.0. Meanwhile, MSC's decreasing trend, particularly in its quick ratio, signals a possible risk in managing liquid assets effectively. Overall, Press Metal demonstrates better financial health in the short term through stronger liquidity management and lower dependency on inventory. This gives the company a stronger buffer to face any short-term obligations. Now maybe let's move forward to the next ratio.
I will continue our analysis by presenting the activity ratio for both companies. Let's start with Press Metal working capital turnover. For Press Metal, the working capital turnover in 2021 is very high at 24.72. This means the company generates nearly 25 times its working capital in sales, a sign of aggressive and highly efficient operation, possibly due to post-pandemic recovery demand. However, over the next 3 years, this ratio declined significantly and end at 4.75 in 2024. This suggests a strategic shift, either due to an increase in current asset like inventory and receivable or slower sales growth. Despite the drop, it's still considered healthy, which is at 4.75. Overall, this trend reflects a move from aggressive capital use to a more stable and sustainable operation model, like focus on long-term risk management and expansion. While for Malaysia Smelting Corporation, this company had a lower starting point at 3.12 in 2021. However, its ratio increased steadily over the 4 years, reaching 4.32 in 2024. This consistent upward shows improving efficiency in managing working capital, possibly due to faster receivable collection, better inventory turnover, and stricter cost control. Even Malaysia Smelting never reached precious metal 2021 level. Its steady growth highlight a disciplined and conservative approach in managing short-term assets. This signals that Malaysia Smelting is steadily enhancing its operational productivity and cash conversion cycle. Alright, next let's look at asset turnover, which measure how efficiently a company uses its total asset to generate revenue. For precious metal, the asset turnover improved from 0.77 in 2021 to a peak at 1.02 in 2022. This means in 2022, the company generated RM 1.02 in sales for every RM 1 ringgit in asset, a strong sign of asset efficiency. From 2023 to 2024, the ratio declined slightly to 0.90. This drop may be due to a growing asset base from the new investment in facilities or equipment which haven't fully converted into revenue yet. However, a ratio close to 1.0 is still solid for a capital intensive industry like aluminium. While for Malaysia Smelting, the asset turnover show a consistent increase year after year, rising from 0.82 in 2021 to 1.23 in 2024. This indicates the Malaysia Smelting has become more effective in using asset to generate revenue. The improvement suggests better productivity, smarter use asset, and reduction idle capacity. It also shows that recent investment, such as in mining or production facilities, are paying off. This steady growth demonstrates strong operational execution and good capital efficiency. Alright, next let's move on to the comparative analysis for the activity ratio for both companies. First, looking at the working capital turnover, we can see that precious metal had an exceptionally high ratio from Malaysia Smelting Corporation because of the precious metal starting from 24.72 in 2021, which we can see that while Malaysia Smelting starting from 3.12 in 2021, but actually it shows steady improvement over the 4 year, reaching 4.32 in 2024. This reflects gradual enhancement in efficiency, especially in managing current assets like inventory and receivable. Malaysia Smelting never matched precious metal at earlier peak. Its consistent upward trend shows a disciplined and stable approach in managing operation resources. For asset turnover, we can see that precious metal improved from 0.77 in 2021 to 1.02 in 2022, while Malaysia Smelting consistently from 0.82 in 2021 to 1.23 in 2024. This shows that it is making better use of its asset to generate revenue, possibly due to the increased mining efficiency and better capacity utilization. So, we can conclude that precious metal starts strong but has shifted toward a more balanced and stable growth strategy, while Malaysia Smelting, slower at the beginning, it is showing continuous improvement in both working capital and asset usage. Both companies actually show strength but in different way. Precious metal in early aggressive growth and capital reinvestment, while Malaysia Smelting consistent in efficiency gains over time.
Hi, my name is Muhammad Fazil Iman bin Muhammad Fazil, and today I'm going to explain the profitability ratio for these two companies, which is Precious Metal Aluminium Holding Berhad and Malaysia Smelting Corporation Berhad. So let's begin with the profit margin, which reflect how well a company turns its sales into profit. So, the pressed metal aluminium holding Berhad maintained a solid performance despite a slight dip from 11.78% in 2021 to 11% in 2023. So the margin remained in double digits, which is actually strong for a manufacturing company. Then in 2024, it rebounds to 40.25%, likely due to better cost control, strong pricing, and perhaps increased efficiency through scale or automation. So this trend shows pressed metal aluminum holding Berhad is not only resilient but quick to adapt and also maintaining profitability even in a tough condition. Next, the Malaysia Smelting Corporation Berhad. In contrast, Malaysia Smelting Corporation saw its profit margin actually fall steadily from 11.01% in 2021 to just 5.53% in 2024. So this nearly 50% decline actually points to a rising cost, global tin price volatility, and possibly operational inefficiencies. So Malaysia's smelting corporation may be struggling to pass on higher costs to customer or manage expense efficiently, which is putting pressure on its earning. And then compared to the pressed metal and MSC clearly faces more challenge in sustaining their margins. Alright, moving on to return on equity or ROE. Okay, moving on to return on equity or ROE. So for pressed metal aluminum holding Berhad, ROE began at 11.78% in 2021, dipped slightly in 2022, then surged to 20.62% in 2024. That's significant improvement actually. So ROE above 20% is considered excellent. It's likely reflect increased net income, effective reinvestment, and good cost control. So pressed metal aluminum holding Berhad is clearly delivering strong value to shareholder by converting equity into profits efficiently. And then let's move to the Malaysia Smelting Corporation Berhad. They start strong actually at 20.41% in 2021, but its ROE declined each year to 12.06% in 2024, which 12% is still fair. The downward trend signal weaker earnings, higher costs, and less efficient use of capital. So it's raised concern about MSC's ability to maintain long-term shareholder value. So compared to pressed metal rising performance, MSC appear to be facing structural or operational hurdles. Right now, let's summarize the profitability performance of both companies side by side. So let's start with the pressed metal aluminum holding Berhad. Actually, both indicators are rated excellent. The profit margin recovered from 11% in 2023 to 40.25% in 2024. So reflecting its strong cost control and effective pricing strategies. So for the ROE, rose sharply actually to 20% to 60%, showing high shareholder returns and efficient use of equity capital. In contrast, Malaysia Smelting Corporation Berhad is rated poor in both areas, which is the profit margin declined steadily from 11.01% to 5.53%, suggesting rising cost and reduced operational efficiency. So the ROE actually dropped from 20.41% to 12.06%, pointing to a weaker ability to generate returns for shareholder. So overall, the PMAH is clearly strengthening its financial position, and Metals Smelting Corporation is showing sign of stress in profitability and must act quickly to reverse the declining trend. Right.
Hello everyone, and my name is Muhammad Shabil Mokhtar. Welcome to these presentations on the comparison of a leverage ratio between Press Metal Aluminium Holding Berhad and Malaysia Smelting Corporation Berhad, or MSC. Today we are focusing on two important financial metrics: the debt of equity ratio and the debt ratio from the years 2021 to 2024. This ratio helps us understand how much debts the companies are using to finance their assets. Okay, let's start with the debt to equity ratio. For the press metal, we can see a significant decrease from 188.85% into 2021 to just 61.42% in 2024. This tells us that the company is shifting from relying heavily on the debt to using more equity for financing. A strong sign of improving financial health and reduced risks for investors. On the other hand, MSC also reduced its ratio from 126.45% to 75.86% over the same periods. While this is a positive move, the improvement is not aggressive as a press metal. In short, press metal is showing stronger control over and financial leverage, which means it's less risky and more attractive to investors. Next, look at the debt ratio. Press metal once again showed a great performance, dropping from 65.38% to 38.05% between 2021 and 2024. This means a largest portion of its asset is now being financed through equity rather than debt. MSC, however, saw a more modest decline from 55.85% to 43.14%. While this is still an improvement, it suggests that MSC continue to rely more on that. Here again, press metal take the lead with a more stable capital structure and lower financial risks. This table clearly shows the press metal outperform MSCs in both key leverage indicators. Press metal demonstrate more effective debt management, a healthier balance sheet, and lower financial risks. For the conclusions, overall, press metal demonstrates stronger financial performance than Malaysia Smelting, with better liquidity and efficiency and lower debt and higher profitability. This is make a more attractive and stable investment choice. In summary, press metal leads in all key financial areas, while Malaysia Smelting still face challenge. Investors looking for growth and lower risks would likely favor press metal. To conclude, press metal stand out with consistent financial strengths, making a better performer and a smarter investment compared to Malaysia Smelting. Thank you for watching. I hope this analysis will provide you with a clear and informative overview. If you have any questions or would like further insights, feel free to reach out. Thank you.
Now let's move to the recommendation. So let's start with the recommendation 1, which is strength liquidity through inventory management for the Metals Smelting Corporation. So first, for Malaysia Smelting Corporation, the focus should be on improving liquidity by improving inventory. The company currently holds a large portion of its asset in stock, which limit cash availability during tight periods. By adopting just-in-time stockpiling and enhancing demand forecasting, Malaysia Smelting Corporation can better align production with actual market needs. So this strategy actually reduces excess inventory and frees up working capital. So if you look at this way, the result maybe can be improve in cash flow and better liquidity position, and also reduce reliance and short-term debt. And then let's go to the recommendation 2, which is maintain capital efficiency and sustainable growth for the precious metal aluminium holding Bhd. So the recommendation is to continue its strong momentum by focusing on capital efficiency and sustainable growth. So the company should keep reinvesting retained earnings into areas such as product innovation, operational efficiency, and cleaner production method. So expanding into value-added downstream segment will enhance its market position. At the same time, maintaining low financial leverage by avoiding excess debt helps manage risks. So the result can be sustained competitiveness, profitability, and also continued investor trust. And then let's move to our third recommendation, which is the restructure capital to reduce debt exposure for the Malaysia Smelting Corporation Bhd. And then the MSC company should reduce its debt dependency by restructuring its capital. This can be done by refinancing high-interest loan with cheaper or long-term alternative, including government-backed financing where possible. So the MSC company can also consider equity-based financing, such as issuing new shares or bringing in strategic investors. Internally, tightening cost control and improving operational efficiency will support cash flow. So in result, the MSC can lower financial risk and also stronger financial flexibility that can moving forward.